Hello and welcome back to the QuantScore Financial Show, your go-to source for cutting-edge market analysis and data-driven investing insights. Whether you're a seasoned trader, a curious investor, or just someone who wants to understand the numbers behind the headlines, you're in the right place. Here, we break down the market using cold, hard data. No hype, no speculation, just the facts and figures that matter most. Our team dives deep into the numbers, analyzing trends and patterns that most people overlook. Remember, this video is not financial advice. Our goal is to educate and empower you by sharing a transparent look at the numbers and strategies that drive the market. Always do your own research and consult a professional before making investment decisions. Our mission is to pull back the curtain on quantitative trading and share what our algorithmic models reveal. We use advanced analytics and machine learning to uncover insights that can help you make smarter decisions. Specifically, for the week beginning July 28, 2025, we'll break down 5 companies we feel are undervalued opportunities, 5 overvalued situations to be aware of, and include the biggest outliers on each end of the spectrum, showcasing the most extreme cases. And if you're excited about these insights, smash that like button. So grab your coffee, tea, energy drink, or whatever gets you amped up for numbers and finance, hit that like button to support the channel, and let's jump right into the data-driven world of QuantScore. Let's get started. First up, we have Baidu, a tech giant that often flies under the radar for many investors outside of Asia. Baidu is often called the Google of China, and for good reason. It dominates the Chinese search engine market, providing a wide array of online services, from search and AI to cloud computing and autonomous driving. Currently, it's trading at $90.80, with a market cap of $31.58 billion, making it a significant player in the global tech landscape. Now let's dive into some key metrics. Baidu's price-to-earnings growth ratio is a reasonable 2.59, well below the tech sector average, suggesting it might be undervalued compared to its peers. This suggests the market hasn't fully priced in Baidu's future earnings potential, indicating a possible buying opportunity if you believe in their growth trajectory. Their forward price-to-earnings ratio is also shockingly low at 12.38, something not often seen compared to US companies, but seems to be a more common occurrence as of late throughout the foreign and emerging markets, and will continue to do so according to the famous Professor Scott Galloway, a belief we share with him. Its ROE, or return on equity, is reasonable at 9.4%. This makes sense to us since they do not carry too many liabilities, with a quick ratio of 2 and a current ratio of 2.3. Looking at growth, quarterly revenue just barely increased at only 3%. But Baidu absolutely crushed quarterly earnings, up 45%. Our algorithms gives Baidu a quant score of 12, a solid start for our undervalued list for the trading week beginning July 28, 2025. This is not a buy recommendation, of course, but it's definitely a stock to investigate further and do your own investigation on. The numbers point to a significant disconnect between its current price and its potential intrinsic value. Based on our charts, we estimate the stock should be valued in the region of $108. Baidu's efficiency and growth metrics make it a standout for the week, warranting a closer look. All right, let's move on to the second on our list of undervalued stocks and explore another potentially interesting opportunity. Next, we have Avantor Inc., ticker symbol AVTR, a legendary leader in the life sciences sector with a history going back to 1904, and have been on an absolutely acquisition spree since 2010. Closing Friday priced at $14.21 with a market cap of $9.55 billion. Avantor currently trades at a forward price-to-earnings ratio of 13.61, exceptionally low for healthcare and indicating strong earnings are expected soon. Return on assets and return on equity were both solid as well, at 3.5% and 12.5% respectively. All of this brings the quant score for Avantor Inc. this week at 17, signaling strong undervaluation. The market may be missing the story here, but it is a compelling candidate for further research. So don't overlook this healthcare giant. On to the next stock. Third up on our undervalued list, we have United Parcel Service, better known by their ticker symbol UPS. The global logistics powerhouse, closing Friday's aftermarket at $103.56, equaling a market cap of $6.82 billion. With a price-to-earnings growth ratio of 1.52, an extremely low ratio for a blue-chip dividend stock. Combined with a forward price-to-earnings ratio is 14.5, UPS is signaling they are expecting a future build with profit. In addition to their earnings metrics, they utilize their equity wonderfully, with the highest return on assets on our undervalued list this week, coming in at a remarkable 36%. Although not nearly as exemplary, UPS still also managed the top return on assets on our undervalued list as well, returning 7.34% compared to their assets, simply solid efficiency. The market seems overly pessimistic about UPS's short-term challenges, but their financial metrics and our algorithms are pointing in a positive direction, coming in this week with a Quant score of 18. UPS is a classic value play right now, so we strongly recommend keeping an eye on this logistics deity. Next up, let's jump back to the life sciences sector. Next on our list, we have Teleflex Incorporated, ticker symbol TFX. A surgical and medical instrument specialist, most recently trading at $117.19, giving it a market cap of $5.13 billion. Teleflex is leading our list in both earnings ratios, currently selling at a forward price to earnings of just 8.55, a metric almost unheard of to see below 10. Add to this a supernatural price to earnings growth ratio of 0.15, both metrics easily diagnosing undervaluation. With modest return on assets and return on equity, both around 4% likely due to high leverage, Teleflex truly pinged our algorithms with their absolutely incredible quarterly earnings growth, up nearly 550%. Our model sees a big opportunity with Teleflex, scoring it a Quant score of 22 for the week. Teleflex is being overlooked simply due to temporary headwinds. But in our opinion, this is a textbook case of market overreaction. If growth continues, the upside could be significant. Definitely worth a deeper dive into their financial for those adventurous value seekers. And last, on our normal list of 5 undervalued stocks for the week, we have Billcom Holdings Inc., ticker symbol BILL or BILL, a financial operations platform to streamline businesses' financial processes. Trading at $45.92 with a market cap of $4.66 billion, Billcom Holdings offers amazing opportunities for business. Although the metrics for Bill may not be the most glamorous, with modest return on assets and return on equity, integrated with marginal quarterly growth, our algorithms like the idea of simplified financials, scoring Bill with a Quant score of 35. As AI continues to improve and small to medium-sized business are being pushed out by larger conglomerates, we can understand the less than stellar metrics or hesitation to invest. But if growth continues, the upside could truly be significant, at least enough to justify a deep dive into their financials for value seekers looking for growth potential with a solid outlook on future earnings. And now, for a special treat this week, we are discussing an QuantScore Outlier, due to data metrics far beyond the sample size average. Without any further ado, let's check out our Undervalued Outlier for the market week beginning July 28th, 2025.
Let's dive into a company that our algorithm flags as an undervalued outlier, a potential gem hidden in plain sight, potentially due to their questionable financial metrics that do little to explain for astronomical QuantScore. This week we're talking about Rivian Automotive, the EV disruptor aiming to redefine the automotive landscape. They're not just building electric vehicles, they're crafting an entire ecosystem around sustainable transportation. Currently priced at $14.01 with a market capitalization of $16.91 billion, the company doesn't yet have a positive PE or PEG ratio, which is surprisingly typical of an early-stage growth story. Rivian is in the phase of heavy investment and expansion. Return on assets, ROA, and return on equity, ROE, are also negative, but these are common characteristics for companies in such an early stage of development. The resulting Quant score. Somehow an electrifyingly high 96, something unexplainable by financial metrics alone. This is a high-risk, high-reward scenario, making it a pure growth play for investors with a strong risk appetite. Traditional valuation metrics simply don't apply in this situation. It's all about the momentum and future potential. If Rivian can sustain this growth trajectory, the market could rapidly re-evaluate its position. This investment isn't for the faint of heart, requiring a stomach for volatility, but it presents a fascinating opportunity for those seeking an outlier with significant upside potential. Now, with that high-growth, high-risk play examined and that finalized our undervalued stocks for the week, let's shift gears and explore the other end of the spectrum, focusing on potentially overvalued companies. First up on our list of potentially overvalued stocks, Ryan Specialty.
Ryan Specialty Group Holdings Inc., insurance brokerage with the ticker symbol RYAN. Ryan currently trades at $66.25, with a market cap $16.91 billion, with our data indicating no positive price-to-earnings growth ratio. With a forward price-to-earnings ratio of 30.86, earnings metrics, at least the available ones, are unnecessarily high, suggesting we need go get insurance against the price. Ryan had commendable quarterly growth, but not enough to justify to continued investment when better opportunities are available. The problem: the market has already priced in this growth and then added some on top, explaining their quant score of 24 the week on the lowest end of our overvalued list, but still a warning sign, so caution is strongly warranted here. But let's keep it going. Second up on our list of overvalued stocks, we have Elbit Systems Limited, ticker symbol ESLT, defense electronics leader. Closing this week priced at $452.82. With a market cap of $21.16 billion, Elbit Systems is showing no available forward price-to-earnings ratio, pinging a red flag in their system. Quarterly growth metrics were extremely solid, with earnings up 42.4% and revenue up 22%. Regardless of their tremendous quarter, their Quant score for the week came in at 29, indicating the stock may have priced in all the good news for the next year or so. Solid company, but valuation risk is high. Don't ignore the warning signs. Next up on our list, Constellation Energy. Let's break it down. Constellation Energy Corp., a major clean energy producer with the ticker symbol CEG, is currently trading at $327.35, equating to a market cap of $100.82 billion. Constellation's PEG ratio is not great, coming in at 3.63, while their forward price-to-earnings comes in relatively stronger at 33.56, both still signaling decent overvaluation. Our algorithms calculated a quant score of 34 for Constellation, explained mainly due to an 86.4% decline in quarterly earnings, something not often seen, pricing the company for absolutely perfection, detached completely from evaluating the company based on fundamentals. High growth potential, but subsequently high risk if expectations aren't met. Please approach with caution. Let's move on to our next overvalued stock this week. Fourth up for our overvalued stocks, we have Interactive Brokers Group Inc., ticker symbol YBKR, a leading brokerage for active traders, currently priced at $65.50. With a market cap of $110.72 billion, Interactive Brokers is trading at an incredibly high price-to-earnings growth ratio of 4.35, with a better forward price-to-earnings factored at 33.33. Quarterly growth was impressive, with earnings up 23.6% and revenue up 19%. But valuation still seems stretched. The business is excellent, but the stock price may have run too far ahead, valued this week at 35. Great company, but the risk is in the price. Last up for our normal list of overvalued stocks this week, we have Robinhood Markets Inc., ticker symbol HOOD, famous for commission-free trading. Currently priced nearly all-time highs at $104.85, with an associated market cap of $89.95 billion, Robinhood Markets is currently not trading with a positive price-to-earnings growth ratio, with a forward price-to-earnings ratio not much better at 72.46. ROA and ROE are both solid, reflecting a recent surge in profitability. And quarterly earnings were up more than 100%, with quarterly revenue up 50%, absolutely explosive growth for the Gen Z investment app. But the market is pricing in years of this growth, factoring in no hiccups. But the future shows no growth to begin with, let alone zero hiccups. As for the QuantScore this week, for the company that tops our normal overvalued list, a full share of 54, no fractional QuantScores here. This is a classic bubble warning, so please tread carefully if you're considering hood. And finally, to discuss our overvalued outlier for the week. And lastly, for this week's episode of the QuantScore Financial Show, our overvalued outlier for the week, we have ARM Holdings plc, ticker symbol ARM, a semiconductor architecture giant based out of Cambridge, England, and is a hopeful driver powering the AI revolution. Closing the aftermarket on Friday, priced at $163.17, ARM is currently valued at a market cap of $169.47 billion. With a price-to-earnings growth ratio of 2.79 and a forward price-to-earnings of 86.96, values extreme even for tech. The market is betting on ARM dominating the AI chip space for years to come, but the competition and volatility that follow the sector seem too bearable to the Cambridge company to keep up. Our Quant score for the week, an electrifying 127, signalling extreme overvaluation rarely seen at such a level. The numbers say, be very cautious. But that wraps up our weekly picks, so let's close with some final thoughts. That's our rundown for the week. 12 stocks flagged by the QuantScore algorithmic models for the stock market trading week beginning July 28, 2025. We've seen undervalued giants, overvalued high flyers, and 2 wild outliers. Remember, this is not financial advice, just a data-driven starting point for your own research. The key: dig deeper into the numbers, question the story, and don't chase the hype. Let me know your thoughts in the comments. Are you watching any of these stocks? If you found this helpful, hit the like button and subscribe to the channel to stay up to date for next week's analysis. Thank you so much for watching, and until next time. Stay calculating, my friends.